What's up everyone, it's Austin Rutherford. Have you ever wondered how the rich seem to never have to pay taxes? Have you ever heard the story about like Amazon pays no taxes or Jeff Bezos pays no taxes? Yeah, I was curious as well, so I looked into it. So in this video, I'm gonna share with you some of the strategies that I've learned that these people use to not pay taxes. Quick disclaimer, I'm not a CPA, I'm not a tax advisor. Make sure you do your own due diligence with your own people. But when I learned these things, it blew me away. And it's actually possible for anybody else to do the same thing. So make sure you smash that like button for the YouTube algorithm. Let's get started. So there's multiple different strategies, but one of the biggest ones is something called depreciation. Depreciation is basically when you own a piece of real estate, for instance, you own a piece of real estate and you depreciate it, meaning you write it off, you take a loss on paper every year for a certain period of time. Now, residential real estate can be depreciated over 27 and a half years. So what does that even mean? Like, okay, Austin, I can depreciate for 27 and a half years, but like, what does that mean for taxes? I'm gonna show it to you. So what this looks like, if you go out and you buy a $500,000 house, for example, you can depreciate it over 27 and a half years. So if you take 500,000 divided by 27 and a half, your write-off every year for the next 27 and a half years will be $18,181. But that doesn't mean that's necessarily the taxes that you save. That just comes off the total income that you have in the year. Now, let's just say, for example, you're at a 40% tax rate. So you pay 40% of the money that you earn, you pay 40% in taxes. So what this actually means, though, if you take 40% of $18,181, it means that you'll actually save $7,272.73 in actual taxes. So remember, if you save money in taxes, it means that it's actually more profit to the bottom line. Like, it's more money that you actually get to keep in your pocket. There's a saying out there and it goes, it's not about how much money you make, it's about how much money that you keep. So in this circumstance, you're keeping an additional $7,200 that you could keep in your pocket instead of paying the government. And again, this loss right here, the $18,181, is a loss on paper. It's not a real loss in real life. You can make money renting this property and lose money on paper and save $7,200 a month. But it gets better. So let's say you buy like a bigger property, right? Let's say you buy $1 million house and you depreciate it over 27 and a half years. It means your write-off per year is $36,363.64. So what does that actually mean for tax savings? Again, if you're at a 40% tax rate, it means that you're gonna save $14,545 in taxes for that year, which means you get to keep $14,454 in your pocket instead of paying the government. So this gets even better though. That's just regular depreciation. Now there's something called a cost segregation study. So you can do a cost seg on a building or a single family house or an apartment building that you own. And basically what happens is an engineer goes in and does a cost seg and determines how much of that property you can speed up the depreciation. So instead of it taking it over a certain period of years, you can speed a lot of it up to the first year and then take depreciation every year thereafter, a little bit less because you took so much in year one, but you can save a massive, massive amount in taxes doing cost segregation studies. So I'm gonna show you what that looks like. So here we're using the same examples. I'm just gonna show you what it looks like as a cost segregation study. And remember, when you're doing a cost seg, you get more depreciation in year one, but every year thereafter you get a little bit less because there's less of a property to depreciate. So this only really makes sense if you're gonna hold the property long term, because then you can speed up the depreciation on year one. But what this looks like is you take $500,000 and instead of dividing it over 27 and a half years, usually when you do a cost seg, the engineer determines roughly somewhere in the 20 to 30% of the building, of the cost of the building, land is not included, but of the cost of the building can be sped up and depreciated in year one. Remember, consult with your own legal counsel, consult with your own attorney, your own CPA to make sure this is done correctly. But for an example, let's just say we use 20%. So that means you're able to write off $100,000 on year one, which means actual tax savings in your pocket is $40,000 that you'll save on taxes on one $500,000 property. It's crazy. And again, as this gets bigger, as you do bigger deals, it makes more and more and more sense. So let's do this for $1 million property. Again, we're going to assume 20% roughly is what you're able to speed up to year one depreciation using a cost segregation study. You get a $200,000 year one write-off, meaning that you actually save $80,000. You get to put an additional $80,000 in your pocket that you do not have to pay to the government. This is amazing, guys and gals. Like, this is how The rich get richer. This is why people own real estate, is because they get amazing tax benefits. You can make money in real life. You can rent that out and make money. But on paper, you can lose money and you get to write it off and you get to save money in taxes. And remember, if you use the cost segregation study, I said this before, I just want to clarify, you get more depreciation year one, you get less depreciation every year thereafter. So I just want to clarify that real quick. And another tax savings that people use is if you buy a vehicle over 6,000 pounds for your business, you can write that off. So let's say you're a construction worker and you go out and you buy a $100,000 truck. You spend 100 grand on it. You can even get that truck financed. You don't have to pay cash. So you get a $100,000 truck financed. If it's more than 6,000 pounds, it's written into the tax code. Again, consult with your own CPA and advisors. This is not financial advice or legal advice, but you can write off $100,000 year one, which means that you would save roughly $40,000 in taxes by buying a truck, by buying something that you get to enjoy, again, for business purposes, but you're able to save money that way. And it gets even crazier. You can do this on vehicles, you can do this on jets, you can do this on yachts, you can do this on heavy equipment and machinery. It really starts to get wild the deeper you go down this rabbit hole. And then another one that most people know about are retirement accounts. So you can put $6,000 a year into your retirement account if you're less than 50 years old, or $7,000 a year into your retirement account if you're greater than 50 years old. And there's a traditional and there's a Roth, right? So a traditional IRA means that you do not pay taxes on it today. You get a write-off today, and then it grows in value over the years. And then when you pull the money out years down the line, you then pay taxes on the money that comes out, right? But a Roth IRA, you put money in, you pay taxes on it today, you do not get a write-off on it, but then that money grows every year thereafter. And then when you pull money out at the end, when you're 65, well, however old you are when you want to start pulling money out, you do not have to pay taxes on it. It's an amazing thing. Like, there's stories out there how people turn, $10,000 into billions of dollars in their Roth IRA, and they don't have to pay taxes on it because it's inside of their Roth IRA. Like I said, it gets wild. The jets, the yachts, the art pieces, the donations, like, you can go as far down this rabbit hole as you want, but these are some of the top ways that people save money on their taxes. And I get this question all the time on social media, and I'm like, talk about a flip and how much money that I made. And somebody always comments on there, you're like, yeah, but you didn't talk about the taxes, or nope, you didn't make that much, you didn't talk about the taxes. I got a few points for that. One, we all already pay taxes anyways. So duh, you gotta pay taxes. Two, as a business owner, entrepreneur, there's ways to not pay taxes through some of these strategies that we just discussed that's, again, written into the tax code. So if you want to be a business owner and make money, there's ways to not pay taxes. And three, at the end of the day, I would rather make money and owe some taxes than be broke sitting on my couch. Let's just keep it real. Anywho, comment below, let me know your thoughts on this video or any other tax saving strategies that you've used in the past or have seen somebody else use in the past. Comment below, let me know. While you're down there, make sure you smash that like button for the YouTube algorithm. It'd be greatly, greatly appreciated. Hit that subscribe and notification bell so you can get all this content going forward. As always, appreciate you being here. We'll see you on the next one.